Hello and welcome to Impact Tuition. We continue our discussion on the standards that cover tangible non-current assets within the scope of the financial reporting syllabus. We've discussed 3 out of 4 standards, and we'll look at the last one today. We have IAS 40, IAS 16, IAS 20, and IAS 23. We've looked at 40, 16, and 20. We'll be discussing the last one, IAS 23, today, and this is borrowing costs. Let's begin. Borrowing costs regulates the extent to which entities are allowed to capitalize borrowing costs incurred on money borrowed to finance the acquisition of certain assets. There are times when businesses go for loans or borrow funds to construct or acquire an asset. This standard, IAS 23, regulates the extent to which we can capitalize certain borrowing costs and expense others. So at the end of our discussion, we would know the costs that are eligible for capitalization and the ones that we should expense. Borrowing costs must be capitalized as part of the cost of an asset if the asset is a qualifying asset. We should note, to capitalize the borrowing cost as part of the cost of the asset. If the asset is a qualifying asset. So what is a qualifying asset? A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. That is a qualifying asset. An asset that takes a substantial amount of time to get ready for intended use or sale. Could be 6 months, a year, 1.5 years, 2 years, or more. Commencement of capitalization. Borrowing costs should be capitalized as part of the cost of an asset when all of the following conditions are met. The first condition Expenditure for the asset is being incurred. The second, borrowing costs are being incurred. And then the third one, activities that are necessary to prepare the asset for its intended use or sale are in progress. Activities necessary to prepare the asset for intended use or sale are in progress. These are the three conditions that must be met for capitalization of borrowing cost to begin. Expenditure for the asset is being incurred. We have actually started making expenses towards the asset. The next is borrowing costs are being incurred. Here we have gone for the loan, or we've borrowed the funds and we have started incurring borrowing costs. When that happens, then we should commence capitalization. Activities to prepare the asset for intended use or sale are in progress. If we are constructing the asset, we've begun construction. Or activities that will prepare the asset for its intended use or sale. Now, if all of these conditions are met, then we begin capitalization. Interest to be taken. The rate of interest to be taken. The rate of interest to be taken depends on two things. The first is whether funds are borrowed specifically to acquire or construct the qualifying asset. And the second is where funds for the project are taken from general borrowings. Now, where funds are borrowed specifically for the qualifying asset, what rate of interest is to be taken? The rate of interest should be the interest attached to the loan. The interest rate attached to the loan or the borrowing, less any investment income. There are situations where all the funds will not be required immediately, and so the entity could decide to invest a portion of the amount borrowed. To get our amount to be capitalized, we take the interest rate attached to the loan, multiply that by the loan, and then take out any investment income, and that will give us our net amount to be capitalized. Now, where funds are taken from general borrowings, the rate to be taken is the weighted average cost of general borrowing. Weighted average cost of general borrowing. There are times where entities borrow a lot of money from different sources, and then they put all those borrowed amounts together into a pool. Now, each of these borrowed amounts have different rates tied to them. So where funds are taken from general borrowings, we need to calculate a weighted average cost of general borrowings to help us capitalize our borrowing cost. Let's look at an example of these two scenarios to see how it is calculated. Illustration 1. Specific borrowing. Majesty Enterprise received an 80 million 5% loan. $18 million 5% loan to finance the construction of a new factory. Majesty Nuts immediately invested 6% in 2%, invested $6 million in 2% bonds until May 31st, 2018. Invested $6 million in 2% bonds until 31st May 2018. The third thing to note is that construction of the factory began on 1st March 2018 and was completed on 31st December 2018. We are required to calculate the amount of interest to be capitalized in respect of the factory as at 31st December 2018. Let's go over our question. Majesty Enterprise received $80 million 5% loan to finance the construction of a new factory in 2018 on 1st January 2018. Majesty Nuts invested $6 million in 2% bonds until 31st May 2018. Construction of the factory began on 1st March 2018 and was completed on 31st December 2018. What is the amount of interest to be capitalized in respect of the factory? our solution. Now, interest will only be capitalized during the period of construction, which is from 1st March to 31st December 2018. Construction period is from 1st March to 31st December, and this is equal to 10 months. Since 6 million of the funds was invested, any interest will be deducted from the amount to be capitalized, and interest incurred or earned before construction commences will be recognized within the statement of profit or loss as an expense. So pre-construction period is from 1st January to the end of February. So let's say 28th February, which is 2 months, because construction began on 1st March. Right. So let's present our answer. We have the interest payable, which is the whole amount borrowed, 80 million times 5%. And this is giving us 900,000. Pre-construction interest. Now we borrowed on 1st January. We started construction on 1st March. So we have 2 months of pre-construction interest, which should be expensed in the profit or loss account. So reduce the 900,000 by the amount of pre-construction interest. Pre-construction interest is 18 million times 5% times 2 over 12, 2 months out of 12, this one. And this is giving us 150,000. We take this out, and we are having 750,000 as the capitalized interest cost. Now let's look at the interest earned. We invested 6 million in 2% bonds until 31st May 2018. So for interest earned, we have 6 million in 2% bonds from January to 31st May, which is 5 months. So 5 out of 12. And this is giving us 50,000. We have pre-construction period as well. where the amount was invested. 6 million times 2% times 2 over 12, where we earned an interest of 20. This 20 will be recognized in the profit or loss account, giving us a net interest earned of 30,000. We take this out of our capitalized interest cost, and we'll have a net interest capitalized of 720,000. So this is the amount of interest to be capitalized as part of the cost of the asset. Let's go over what we have just done. We received 80 million 5% loan to finance the construction of an asset, a factory, in 2018 on 1st January. We invested 6 million in 2% bonds on 31st May 2018. Construction began on 1st March and was completed on 31st December 2018. Construction period is from 1st March to 31st December, which is 10 months. Pre-construction period is 2 months, 1st January to 28th February. Now the interest payable is 80 million times 5%, giving us 900,000. Now pre-construction interest, this will be charged to statement of profit or loss. Profit or loss account, pre-construction interest of 150,000. Because during this period, construction had not started, so we can't capitalize the interest incurred during the first 2 months of the loan. So that interest to be sent to the profit or loss account as an expense. Taking the 150 out of the 900,000, we have 750,000 left as interest to be capitalized. We invested the money and earned some income or earned some interest. We invested from January to the end of May, which is 5 months, and our interest is 50,000. Out of these 5 months, 2 months relates to pre-construction. So we take those 2 months out of the entire 5 months, giving us 20,000, and the net interest earned is 30,000. We take that out of the capitalized interest cost, and then we have the net interest to be capitalized to be 720,000 Ghana cedis. It's quite straightforward. So this is it. Let's look at the next illustration for a situation where the funds are from a pool. Right. Illustration 2. Funds are from general borrowing. Okay. An entity had 10 million 6% loan and a 2 million 8% loan. Calculate the weighted average cost of borrowing. An entity has 10 million 6% loan and 2 million 8% loan, and we are required to calculate the weighted average cost of borrowing. Our solution $10 million times 6% plus 2 million times 8% all over the total loan, which is 10 plus 2, giving us 12 million. This is equal to 760K all over 12 million, and this is equal to 6.33%. So the amount to be capitalized would be the amount spent on the asset multiplied by 6.33% per annum. So whatever amount to be spent out of the 12 million will be capitalized at the rate of 6.33%. And this is how it is in calculating the weighted average cost of capital. So if we have about 4 loans, we would add the total loan like we have done over here, and then we will add the other ones. Say 10 million at 3%, and so on and so forth. So we arrive at our weighted average cost of capital. Cessation of capitalization. Capitalization of borrowing costs should cease when either now we stop capitalization or stop capitalizing, taking into consideration 2 things. Substantially all activities have been completed, and construction is suspended. All right. The first thing is that we cease capitalization when substantially all activities to prepare the qualifying asset for its intended use or sale are complete. We cease capitalization. The next is when construction is suspended. Now, this an example is due to industrial dispute. We can suspend construction and as a result cease capitalization during industrial disputes. But we can't cease construction when, say, due to a 1-week rainfall or a month rainfall, construction has come to a halt. We can't suspend capitalization during such a period. But where we have something like an industrial dispute, we can cease capitalization. Let's look at the final thing here, disclosure requirements. One, the amount of borrowing cost capitalized. During the period. And then 2, capitalization rate used. So these are the additional information we have to provide in our financial reports to support the figures we will present in the financial statements. And with that, we come to the end of our discussion on borrowing costs. We looked at the definition of a qualifying asset, commencement of capitalization, rate of interest to be taken. We also looked at some solved examples, and then we ended with cessation of capitalization and disclosure. Kindly like this video, subscribe to the channel, and share with friends who would also need these tutorials. See you in our next video, and thanks for watching.